Last month was the worst month ever for my trading 212 portfolio, and a lot has happened since that month. The S&P 500 since the end of October is up 7%. The FTSE 100 and 250 had a pretty good rally until the Office for National Statistics came out and said that the UK's growth was 0%. So how has all of this news changed the value of my trading 212 portfolio and all the positions I have in it? So this is my trading 212 portfolio, and as you can see, the current balance is £12,581. As you can see, my account value is £12,594, and I have £12.66 in free funds. So pretty much all my money is invested into stocks and shares. So as you can see from the last month, a lot has happened in terms of my portfolio value. You can see that at one point I was down by £800 in my value, and early November when the FTSE 250 was on a rally, I was only down by £139. So currently, as it stands, my return on investment is down by £202.56, and this is an overall, since I started investing, a 1.58% loss in terms of value. However, as we know, as a long-term investor, we don't care about short-term fluctuations. If anything, lower prices mean better for the future, because as a trend and based on historical performance and what we expect, we know that the stock market overall always tends to go up. So if we buy at this point in time, we're more likely to be better off in the future rather than just the short term and now. So first, let's go through all the free shares I've gotten as a result of making these videos. So as you can see, I've received 41 free shares so far, and that's a value of £740. I'm very grateful for everyone as always, and I will show you every month just how many free shares I get. If you would like to sign up to Trading 212, use the link in the description down below, as I will get a free share and you will also get a free share too. And this is worth up to £100, and generally speaking, I always get a share above £10. The minimum I usually get is around £12. So the next thing I want to show you is my history, and this is the history of my portfolio in my Trading 212 Invest account. As you can see, I have a realized profit and loss of £157. The total amount of dividends I've received in this account is £125, which is actually not too bad for a portfolio size that I would say is quite small at around £12,000. Of course, my aim isn't to do short-term trading, so these profit and losses don't really mean anything, because most of what I'm going to be aiming for in the future is capital gains from all those companies that I'm buying now for low being worth more in the future, and I can leverage that and sell it off whenever I feel like I am ready to exit those positions. So let's go through the bottom. I have 0.12 shares in Walt Disney, and as you can see, over the past month, Walt Disney is up by 3.97%, which is actually not too bad for Walt Disney. Currently, my 0.12 shares are worth £9.10, so not a big holding at all. You can see the FX impact here, and essentially what the FX impact is the difference between the US dollar and the Great British Pound. Because they fluctuate all the time, the value of your investments, because you actually have to hold them in US dollars, does kind of change. But then again, if you sell it and keep it as dollars, you don't really have to worry about the FX impact. But in either case, we can see that Walt Disney's revenue has been increasing quite a bit throughout the years. Their net income, however, does seem to be decreasing, and from their balance sheet as a whole, we can see that everything looks quite similar to before, which isn't necessarily a good thing. And I do think as an investor, you have to look deeper than this, than just a glance such as looking at these apps. We can see from cash flow there's a different story. We can see that the financing costs are quite high and the investing costs are also high. Given that Walt Disney is no longer as popular as it used to be, there are a lot of fears for investors that this company may not survive or be as profitable as it used to be. Therefore, we have seen a huge decrease in the valuation of Walt Disney. So next I have 35 shares in Vodafone, and over the past month it is down by 1.41%. As you can see, the trend has been down, down and down. Over the past year they are down by a massive 26%, so it's not looking very good for the value of their stocks. We can see that Vodafone does give out quite a bit of cash in terms of dividends, as their yield is 10.08%, but of course dividend yield is always related to the share price. So because the share price is so low, maybe the dividends in comparison seem quite high. There's no guarantee that if you buy a share at a high dividend yield that you will continue to receive that dividend, because companies can get rid of their dividends at any point. It's a personal choice for them. But anyway, we can see that net income has been increasing and revenue has been staying the same. We can see from the balance sheets that the the liabilities do seem to be decreasing. But however, what they put as assets is kind of murky. So you really do have to look deeper into their balance sheets and see what's stated on them to actually, as an investor, see if you have any value from investing in such a company. From the cash flow, we can see that they're spending a lot on financing, which could be debt and other stuff like that. So next I have 0.8 shares in the Vanguard Germany All Cap. Over the past month, it is down by 0.35%. As you can see, over the past year, the Germany All Cap is down by 5.54%. So it's not doing very well, as is Germany overall not doing too well because of the recession. So next is my biggest holding by far, and that is in the Vanguard FTSE 250. We can see that over the past month, there has been a huge increase since around the 27th of October. This was in response to the Bank of England not raising interest rates yet again, and there was a huge amount of optimism in the UK markets. As you can see, it went up by a huge amount, and recently the news broke out that the UK growth was flatlining, 0% growth, and that reactively led to a slight decrease in the valuation of the FTSE 250. But I'm very happy to be holding in the FTSE 250, as I have been saying for a while now. I own 269 shares worth currently £7,441. That is down overall in my portfolio by £244, down by 3%. But I really do think personally that, you know, it's a great place to be, for me anyway, dollar cost averaging down, as I do think eventually the FTSE 250 will recover. But then again, comparatively, maybe something like the S&P 500 will grow a lot more in a shorter period of time, so it might not actually be the best investment anyway. However, the FTSE 250 does pay around double the amount of dividends of the S&P 500, and it does that by paying 4 times a year, so every quarter. It's a nice amount of cash to be injected to your portfolio every now and then. So next I have 0.17 shares in Tesla. Over the last month, they are actually down by 18%, which is a huge amount. And past year, they have flatlined with only a 3% growth. So Tesla does not pay a dividend yield currently. And as you can see from their revenue increasing near exponentially, net income also increasing. Balance sheets also look very good. However, Tesla is just one of those companies that even the smallest amount of news or speculation leads to huge volatility in their share prices. So yeah, take that for what it is. There is a lot of consensus saying that generally speaking, Tesla is gravely overvalued as a company and what it really does provide, which could actually be the truth. So I would say Tesla personally is a very high risk option because a lot of it is surrounding the fame of the CEO Elon Musk, and realistically, unless you can make huge amount of profits and keep growing, the share price isn't going to just keep on growing indefinitely. So next I have 0.2 shares in Starbucks, and over the past month that is up by a huge 13%. They do pay a dividend yield of 2.19%, and as you can see from the income statement, everything looks pretty good. Revenue is increasing a lot. Balance sheets look very similar since 2020, so I don't think it's something to worry about. And as you can see from the cash flow, a lot less in financing this year. So next I have 1.6 shares in PayPal, and as you can see over the past month, they are down by 5.73%. Over the past year, however, they are down nearly 40%, so PayPal is not doing too well at all. They don't pay a dividend yield, and as you can see from their income statement at a glance, revenue is increasing, however net income is decreasing. From their balance sheets, we can also see that perhaps their liabilities are also increasing. And from cash flow, you can see that they're getting a lot less in terms of operating revenue. Now, this could a lot be due to, of course, the recession type behavior that we're seeing right now. A lot less deposits, so a lot less money made in terms of interest. A lot less of their credit business is in full swing, so of course, they're going to get a lot less operating profit right now. So next I have 2.32 shares in Orange. That's worth around £22.48. Over the past month, they are again quite flatlining, only a 0.19% increase. Over the past year, however, they have seen a 12% growth, which is not too bad at all. They pay a pretty good dividend yield at 6.35%. And as you can see from the income statement, the revenue seems to be quite similar. However, net income is going down for some reason. We can also see from their balance sheets that, you know, their liabilities seem to be increasing somewhat. However, when they list their assets, it's important to actually go in and see what they actually are instead of just relying on this graph. From a cash flow perspective, we can see a lot more costs are going into investing into the business, which could be a good thing in the long run. I seem to have missed Rolls-Royce, so let's go through that quickly. 29 shares in Rolls-Royce. Over the past month, up by 8.69%, which is really good. In the past year, they are up by 172%. which probably would have been one of the best investments you had made this year by far. No dividend yield currently, and as you can see from the income statements, revenue seems to be increasing, net income however decreasing. From the balance sheets you can see a lot more liabilities than their stated assets. However, from a cash flow perspective we can see a lot of it is going through financing, which doesn't always mean a bad thing. So next I have 0.09 shares in Nvidia. Over the past month they are up by 3.27%, and as you can see from the 1st of November they actually went up quite a significant amount. Over the past year, again up by 196%. So like I just said before, Rolls-Royce was a great option. If you had invested in Nvidia, you would have been up by 196%, but considering the FX impact, maybe it would have been just as similar as Rolls-Royce, and of course the foreign exchange fee. They do pay a tiny dividend yield of 0.03%, and from the income statement you can see that revenue is very high, net income is high but not as high as last year. From the balance sheets you can see assets greatly exceed the amount of liabilities, but when we look at a cash flow perspective we can see a lot of it is due to financing. So next I have only 0.4 shares in Nike. Over the past month they are up by a huge 7.46%. Past year they are only up by 10%. So you can see that since again the end of October, Nike has seen an upward trajectory. They do pay a small dividend yield of 1.27%, and as you can see from their income statement, the revenue has been increasing. Net income seems to be decreasing a little bit. From their balance sheets you can see that the amount of stated assets is higher than the liabilities, and from a cash flow perspective you can see a lot of the money is going into financing. So next I have National Grid, and I only have 0.49 shares in that. Over the past month up by 1.57%, and over the last year not doing too good, up by 1.51% overall. In my portfolio it is worth £4.87, down by 1.81%. They do pay a decent dividend yield of 5.81%, and as we can see from their income statement, revenue has been increasing significantly, so has net income. Balance sheets again, assets greater than liabilities, and from a cash flow perspective we can see they spent a huge amount in investing back in 2022. This seems to be paying off, but they are spending a lot on financing these days. Next I have 0.3 shares in Mercedes-Benz. Over the last month they are down by a huge 12.73%, currently worth £19.09 in my portfolio, so that's down by a huge 16.49% in my portfolio. They do pay a great dividend yield of 9.21%, and from income statements you can see that revenue is increasing, net income decreased a little bit. Balance sheets you can see liabilities going down, which could be a good thing, and cash flow we can see a whole lot less operating income. However, financing, they're spending a lot more on that. This is of course due to the fact that during such a time there's less money in the economy and less people are actually going to go out and buy Mercedes-Benz. So next I have 260 shares in the Lloyds Banking Group. That is down in the past month by 3.71%. Over the past year Lloyds has not been doing too well either, down by 2.75% overall. In my portfolio overall it is down by 8.55%. and that is a loss of £10.16. They do pay a decent dividend yield of 5.96%, and as you can see net income has been significantly lowered than last few years. Balance sheets again look pretty similar to previous years, with a high amount of liabilities. Of course, being a banking company, that is quite expected. Cash flow again a lot less in terms of operating income, and of course that is a lot due to the recession. You can see back in 2020 the operating cash flow in was around £27 billion, and a whole lot less this year. So next is my second biggest holding, and that is in the iShares S&P 500. Over the past month, flatlining. However, as you can see, like I said, at the end of October, the S&P 500 is up over 7%. So if you are one of those people that dollar cost averages right at the end of the month, you would have seen a nice 7% gain on that deposit. That beats pretty much any instant access savings account in just 1 month, compared to the 12 months that you would have had to hold that money in. Anyway, still overall I am down by 0.16%, and that is a negative return of £6.29. So next I have 6.2 shares in what is basically Royal Mail. Over the past month, they have not been doing too well with an overall loss of 7.1%. You can see that there was a bit of a rally after the 26th of October and then something happened and it's just gone all the way down. Over the past year, not doing incredibly good at a loss of 4.3%. I believe they stopped paying a dividend yield if they were paying one. However, from their income statement, we can see that the revenue is going down and their net income seems to be going down too. From the balance sheets, we can see the total number of assets is also going down, so I have no idea what's going on in Royal Mail. And from a cash flow perspective, we can see operating income also less than last year. And next I have 23 shares in IAG. Over the past month, up by 1.88%. You can see that since the end of October, they have been seeing a significant rally. Over the past year, overall up by 1.67%. They don't pay a current dividend yield, but as you can see, the revenue has been skyrocketing. That is because they are an aviation company. And of course, as we know, aviation has taken off since the COVID times and everything seems to be going back to normal. From the balance sheets, you can see high number of liabilities and assets, but at least their assets are growing too. Cash flow, you can see a lot in investing and a huge amount extra in operating income. So next I have only 2 shares in H&M. Over the past month, they are up by 1.61%. Over the past year, they are doing quite well at plus 13.8%. They do pay a decent dividend yield of 4.1% currently, and revenue has been going up, net income slightly down. From their balance sheets also, they look like they're taking on more liabilities. And from a cash flow perspective, you can see operating income has reduced and financing is a lot of their costs at the moment. So next we have 0.2 shares in GSK, and that is up by 5.29% in my portfolio. Over the past month, down by 8% nearly. In the past year, down by 3.6%. Dividend yield nearly 4%. You can see that their revenue and net income increasing. Balance sheets also look like they've been selling off assets, but also taking on less liabilities. And cash flow, we can see a lot of money is being spent on investing. So next I have Direct Line Insurance, and I have 2 shares in that worth £3.43. Over the past month, up by 4.23%. In the past year, they are down by a big 15%. They do not pay a dividend yield anymore, and their net income has seen a huge decrease. Balance sheets also look like a lot less assets than before. And from cash flow, we can see that their operating income has increased. However, cost for financing has also increased quite rapidly. So next I have Deutsche Lufthansa, and I have 7.3 shares in that. Over the past month, doing quite well, up by 3.92%. And overall, over the year, up by 6.7%. Again, another aviation company. No dividend yield currently, and as you can see, revenue has been increasing, so has net income. Balance sheet, again, assets are higher than liabilities. And from a cash flow perspective, we can see that compared to the last 2 years, operating income has soared. However, they are spending a lot on investing and financing. So next I have Delivery Hero, and I have 0.67 shares in that. Over the past month, down by 4.57%, and over the past year, down by a huge 39.91%. No dividend yield for them. We can see that their net income is decreasing. From the balance sheets, we can see they're taking on more liabilities. And from a cash flow perspective, you can see they are making a huge amount of losses. You can see that they are in a deficit on their operating. So next, exactly 1 share in Carnival, down by 2% in the past month, up, however, overall in the past year by 18%, which is really good. Dividend yield of 4.28%. Their revenue has been increasing and their net income seems to be increasing year on year. However, you can see taking on more liabilities. And from a cash flow perspective, we can see that they are spending a lot on investing and running on a loss in terms of operating. Next, 18 shares in BP, down 8.23% surprisingly over the past month, and overall down by 4.7%. Dividend yield of 4.78% currently. Revenue has been increasing near exponentially. Balance sheets look okay. And from a cash flow perspective, you can see operating income very, very high. However, a lot of cost into financing and investing. Next, I have BMW, and I only have 0.12 shares in this, but they are down 7% over the past month. However, up 14.64% over the past year. In my portfolio, the value is only £9.78, and that is down by 7.56%, a loss there of 80p. They do pay a high dividend yield of 9.22%, and as you can see from the revenue increasing very well, so is their net income. From a balance sheet perspective, you can see assets cover liabilities, at a glance anyway. Cash flow perspective, increasing operating revenue, however a huge amount spending on financing. 1.37 shares in Aston Martin. Past month down 17%, which is a huge amount actually. Past year up by 84%, but as we can see from their maximum, they are down 99.33%. So pretty much worthless from what they started off before. No dividend yield, however we can see that revenue is increasing, net income is decreasing hugely. Balance sheets also look like more assets than liabilities for now. And cash flow, we can see that they aren't really making a lot through operating. However, they are spending a lot on investing, and some of the financing costs are paying back right now. Next, I have 0.02 shares in ASML. They are up by 6.94% over the past month, and over the past year, they are up by over 30%. We can see maximum, they are up by 817%, which is a huge amount since only 2017. Very small dividend yield of less than 1%. And as you can see from their income statement, increasing revenue and income. Balance sheets also look like their assets are increasing quite rapidly, but from a cash flow perspective, currently less in operating and more in financing. So next I have 0.3 shares in Apple. They are up by 3.72% over the past month. As you can see, S&P 500 since the end of October has seen a huge increase, around 7% overall. Companies like Apple, Microsoft and Google are one of the top companies by market cap in the S&P 500. So when the S&P 500 goes up, they go up pretty much the same way anyway. Past year, Apple has stayed pretty steady at a plus 0.1% increase. In my portfolio, they are still up by 21%, which is actually pretty respectable, up by £8.51. Dividend yield 0.52%, very low. And these companies, their financials are always really good. Revenue is high, not increasing constantly. Balance sheets also look fine. And here is the cash flow. So a lot in operating and a lot in financing. Next, we have Amazon. So 1.1 shares. I finally have a whole share in Amazon, up by 8.91%. Again, same profile that we've seen with the other companies, because these are the top companies of the S&P 500 and technology-based sector anyway. Overall, past year, 57% increase. No dividend yield, however, as you can see from the income statement, everything looks really good, with operating revenue still being much higher than their financing. But these companies have a lot in cash anyway. I then have 0.2 shares in Alphabet. Past month, down by 5.66%. So again, we haven't quite seen the huge increase at the end of October, but we have seen the same kind of profile anyway, but just less deep. In my portfolio, up by 24%, which is again really good. No dividend yield, however, you can see from the income statement, revenue is increasing, balance sheets look really, really good, and cash flow, you can see a lot in operating, but still a lot in financing. Lastly, I have 0.03 shares in AMD. Past month, doing really good, up by 9.5%. Past year, up by 90%. In my portfolio, up by a huge 56%. So that's a £1.12 gain. And I only bought £2 of this company anyway. No dividend yield, but you can see from the revenue, it's increasing rapidly. Balance sheets, you can see the amount of assets they confirmed last year is actually staggering. And from cash flow, you can see investing is paying off, operating is still quite high, but a lot spent in financing. In terms of pies, I only have one pie, and that is a copy of the Almost Daily Dividend pie. Over the past month, you can see there has been quite a lot of fluctuation. Since the end of October, however, we have seen some of the companies going up. This is because the pie is predominantly just American companies, and the American stock market is doing a lot better than the UK one. You can see that I have £375 invested. The portfolio overall since investing is down by £15 nearly, down by 4%. I've received £12 in dividends. This doesn't really cover my loss at the moment, but I do think in a couple of years I would have more dividends and I will have a positive overall portfolio anyway. So quickly to go through the pie, 50 companies, 50 slices. Minimum recommended investment is £400, but I accidentally took out 25, so silly me. Anyway, companies like Apple, Realty Income, Johnson & Johnson, big dividend payers. The aim of this portfolio is to provide dividends on a near daily basis, so I would say weekly anyway. Mostly American companies, as you can see, all of these companies. I'm just going to quickly scroll through it. But if you do want to check it out, there's always a link in the description down below. So now I'm going to go through my Trading 212 ISA. Currently, my balance is £19,972.69. You can see that I have 100% ISA utilization, so this is 1 year's worth of deposits. Currently no free funds. I've invested 21,540, and you may ask the question, how on earth did you manage to deposit more than 20,000? Well, I didn't. I deposited 20,000. I made a few trades at the beginning of this tax year and they were quite profitable, so I just sold those and put them back into these ETFs. If I go through history, you can see that my realized profit is £1,110. This is from the few trades that I've made in the FTSE 250, and as you can see, they've actually paid off. Since then, I've stopped actually trading because it just requires too much watching the market. And overall, in the long term, you can't just keep winning anyway. In terms of dividends, again, not too bad at all. £424. As you can see, dividend from the FTSE 250 twice, once in June and once in September. If I reinvest these dividends back into the FTSE 250 year on year, hopefully we'll see an increase in the dividends. But anyway, only 2 ETFs in my ISA just to make everything very simple. 716 shares in the FTSE 250. Overall down by 7.36%, which is the loss of, listen to this, £1,571. So again, I think long term this will be fine, and it does pay a nice dividend yield 4 times a year, so I'm very happy with that. And lastly, I have 24 shares in the S&P 500. That is actually up by 2%, so that's a £3.74 gain. What I'm going to do is the dividends that I do get from the FTSE 250 are just going to be reinvested into the S&P 500. However, if I see a very good price, for example, at £25 something, I'm going to keep buying into that because I think it's really, really good. Until April of next year, I can't actually deposit any money into my ISA, so it's just going to be the dividends that are going to be reinvested. So make sure to check out some of my other videos, and I will see you in the next video.